The Department of Labor is out with new initial jobless claims this morning, showing a seasonally adjusted 231,000 new applications for the week ending August 24th. That's down slightly from the 233,000 claims the week before. Meantime, employers added 818,000 fewer jobs in the 12 months ending March 2024 than were originally reported. So how much stock should investors put into these numbers as a catalyst for future Fed rate decisions? Here to discuss is David Miller. He is Catalyst Fund's co-founder, chief investment officer, and senior portfolio manager. Lots of catalysts going on in this show, very appropriate for today. But you just heard it there. We see jobless claims coming in roughly flat, upward revisions to GDP. How can you trust this data at this point?
Well, I guess that revision that we had in the BLS data, taking the number down by 800,000 in new jobs created, really implies that you can't trust the data to some extent. Although I think some of those revisions were more based on undocumented immigration and jobs surrounding those that are hard to get to, what is the real number for new jobs created. So I think they're reasonably accurate. I think that revision was kind of overstated relative to the reality. But, we're in a pretty healthy economy.
So you mentioned something key, and this came up in our last hour as well. How much is supply actually skewing the unemployment rate at this juncture because of immigration, because more citizens coming into the U.S. and adding to the broader kind of labor force possible participation rate?
It's a good question. So, look, you're definitely adding to the supply, but there was always plenty of demand, especially for lower income labor, which, a lot of Americans who've been here for a long time aren't willing to do for lower rates. So I think it's pretty healthy for the economy. I think it's contributing to GDP growth. I think it's helping, with this GDP print that we saw today. So I think you're seeing kind of more of a balancing effect. There was really a need for that incremental labor.
And you just said the economy is in a pretty healthy state, but you do see weak GDP growth in the fourth quarter, between 1 to 1.5%. What's the main driver behind that weak forecast, and how do you see that playing out into 2025?
Sure. So, I think it's just the lagging effects of higher interest rates and, those higher borrowing costs for companies. I think when you see rates start to come down, the Fed's expected to cut in September. There'll probably be another cut after that. I think you can probably get back to like 2-3%. Type of GDP growth thereafter, and I think we can see more of a matching effect between what the Fed was hoping for, 2% type inflation combined with 2 to 3% GDP growth.
What does your portfolio playbook look like going into the Fed's cutting cycle?
Sure. So if you look at where we're positioned now, we're long bonds. We're also long equities. Both of those should benefit from the cutting cycle. We're playing calendar spreads when it comes to commodities. So we're not betting on the direction of commodity prices, but we're trying to earn the storage costs associated with those. And then we're also trying to pick up the differentials between yields in different countries. So, if you can borrow in Switzerland or Japan close to 0 and lend in the US or Australia close to 5, those can be pretty good trades as well. So we're trying to play it as diversified as we can as to, where we're picking up our return streams.
And speaking of the Fed's easing cycle, you said in your notes here that a big question for the Fed is not whether they'll cut interest rates by 25 basis points or 50 basis points, but what the path and actions will be after that. Are you referring to the pace of cuts, and what's your base case there?
Sure. So, well, I think they're, going to cut in September. That's almost a given. They're probably going to cut at least one more time after that. It's much more data dependent as to whether they'll keep cutting after those first two cuts. But I think those first two are kind of in the bag, and then, we'll probably be in a bit of an equilibrium thereafter. Rates won't be, higher for longer, but they'll still be a little bit higher. They're not going back to ZIRP anytime soon.
And so with that in mind, some of the top sectors that are really catching your attention right now, we know that technology, when easy as money or money policies become a little bit easier, technology stands to benefit. What are some of the other areas of the market that might catch your attention at this juncture?
So I just really like all of the really high margin, monopolistic type businesses that have really strong tailwinds. So obviously, technology is a great example of that. You look at these companies like Microsoft and Google and NVIDIA. And
companies that don't want to be called monopolies, by the way.
Right. But companies that don't want to be called monopolies, but are, whether well, I'm sure they like it. They just don't want to be called monopolies. Yeah. But then, you look at the Visas and MasterCards of the world. If you combine inflation with more money coming through the system, combined with taking a little cut off the top of every transaction, those are phenomenal businesses as well. If you look at media companies, you certainly also see some inflation in ad rates, and that can flow nicely down to the bottom line. I think it's just tough for these companies that are in more cyclical commodity type businesses, but any of these companies that have EBIT margins of 30% plus and natural growth, those types of numbers compound really nicely over the long run.
And we have an election coming up in November. Any election risks to the market that investors should be aware of?
Sure. Well, I mean, you have the one really big one, which is, what are they going to do with corporate tax rates? And, Trump's made it pretty clear he wants to keep the tax cuts that he's made, when he was in office. And the Dems have made it pretty clear that they want to go back to higher taxes. And then you have some things that the Dems have talked about, but I think are a little bit more political than things that are likely to pass, like, God forbid if they had a tax on unearned capital gains, or unrealized capital gains. I mean, that would certainly be catastrophic to the market, but I don't think anything like that would actually pass, even if they would, carry that as a policy on their agenda.
And of course, it comes down to what the makeup in Congress looks like as well here.
Certainly.
Because the markets certainly do love a little bit of logjam in D.C. David,
Yep.
Thanks so much for taking the time here with us.
Thank you.
David Miller, Catalyst Funds co-founder, chief investment officer, and senior portfolio manager.